So, good evening, everyone, and welcome to another installment of Your Money Matters Financial Empowerment Show. I am your host, Letha Thornton, here to spend a little time with you this week as we seek all things money and finances so that we can become financially independent and hopefully break some curses. So from week to week when we get together, we are trying to bring meaningful information and resources, wealth building strategies and tools so that you can make some informed decisions about your money, which is something that for the longest time wasn't happening, especially in our communities where either the information wasn't available or we had some misconceptions about how things go. Poverty plays a part in lack of knowledge and the whole nine. So, what we did from generation to generation was pass poverty and pass a lack of knowledge when it comes to money and finance. So, now that we are in a different time and we are advancing toward a lot of different things in our communities when it comes to growing and building wealth, the information is out here for people to obtain. And we just want to do our part to make sure that we expose as many people as possible to the information. So I thank you for tuning in, and I hope you find value in what we share today, because this topic is so near and dear to my heart. Realistically, I got probably about 8 years ago, I got some licenses to position me to be able to help families when it comes to building a strong financial house. And this week, we're going to be talking about the importance of life insurance and why it is the foundation to building a strong financial house and creating wealth in our communities. So, I am going to spend a few minutes with you, really going over the different types of life insurance, how life works when it comes to a financial house, why life insurance is so important in that, and what it takes to continue to build a strong financial house. So the title of the show is called Life Insurance, a last love letter conversation, right? One of the things I always love to say is that life insurance really is the last love letter that you will leave to your family, right? You may not be able to tell them goodbye, but you can show them how much you love them by what you leave them, right? We laugh in my office where we say, oh, well, who's your great 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 grandfather? And somebody might not know. But when people leave inheritances to their loved ones, you know who your great 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 grandfather is and the whole nine. And, having this conversation is to bring about awareness so that you can get the right kind, learn how it's used to grow wealth, and why how that Life Insurance Awareness Month came about. So the month of September is National Life Insurance Awareness Month because of a really, really tragic incident that happened on September 11th, right? So um, if you can pull that second slide, I'll be kind of talking from the slides so that you all have some visual aids. Looking at my face, we could definitely talk and talk and talk, but I want you to have some things that might stick out in your mind, things that you can screenshot so that you can be informed. So the September 11th World Trade Center bombings or attacks, right? We all can remember where we were that day. Something happened and I didn't go to class that day. I was still in college and I didn't go to class that day. For some reason, I don't remember what it was, but this particular day, I did not go to class. Leslie, if you got the introduction. I didn't go to class that day, and when I woke up, all I saw was that the first plane had flown into the building. And then I was awake when the second plane flew into the other building. So it was a really, really tragic time for a lot of people. A lot of people lost loved ones. Some people went to work that day, never saw their families again. There were people jumping from the building, all because of a calculated attack on on America, so it seemed. And what ended up happening is over 2,800 people died in that tragedy. And when it was time for these families to be able to bury their loved ones, those who had insurance went to their insurance companies to see if they would pay the claim. I lost my loved one passed away. And there were some companies who did not pay the claim when people passed away in the World Trade Center tragedy, stating that they weren't going to pay because it was an act of war, right? And that wasn't declared till later. It didn't become an act of war until later. And so there were a whole bunch of companies who wiggled out of paying insurance claims. So these families were left on their own. There were only two companies that paid out on these death claims. And I'm proud to be I'm proud to be in one of those companies, but realistically doing the right thing was what was really, really important. And, you may have a policy of some kind, right? As if there's an act of war clause in your policy, because if there's any kind of politically motivated attack or anything like that, and they can use that clause, they find a way to not pay your claim. So this birthed Life Insurance Awareness Month. I've been promoting it and just talking about it a lot because life insurance is often the last thing that people want to talk about, but it is the first thing that is asked when someone passes away, right? So we're going to spend some time talking about the different kinds of life insurance, right? So that you understand how it all works. And so there are people who have no life insurance, right? These are the different types of life insurance situations. I don't have any life insurance at all, um, which is very common as we see the rise of GoFundMe. I only have job insurance, right? I have insurance through my employer. So that is definitely something that we need to take a look at, because if you happen to ever lose your job, get laid off, furloughed, fired, whatever the case may be, you're going to lose that coverage, which is definitely problematic if you have a family. If you work there a while, then you lose coverage, and now you're older and you could have health challenges. So when you go to try to get life insurance outside of the job, it's a struggle, or you just go to from job to job starting over trying to obtain coverage. So that's something that we need to look at. There is a type of life insurance called whole life, or cash value. You may have heard of that. It builds cash that you can borrow against. And then there is term insurance, which is for a period of time, which allows you to rent an estate until you can grow an estate. So let's look at some statistics, and then we'll get into a little bit more. A statistic that I find to be extremely eye-opening, and you can probably see why GoFundMe is on the rise, is nearly half of Americans have no life insurance coverage in 2021. So in the year 2021, there were people who had no life insurance coverage, right? So that is definitely a problem, right? So we can see how we're able to pass poverty, because when a breadwinner passes away and there's no money and there's no coverage whatsoever, it leaves the family to be in financial ruin. 1 in 4 families believe that group life insurance through the job is enough, right? Most experts agree that it is not, right? Because realistically, if you work a job, they pay you 1 to 2 years of your salary, right? Job insurance is a group life insurance policy where you pay into the group and they are the ones that are providing the coverage to you. They make all the decisions, your employer does. So group insurance is definitely something that you want to keep, right? You definitely want to have it because it's very cheap because you're paying into a pot. However, if you leave that job or lose that job, and if you pass away on the job, they're only going to give you 1 to 2 years of your salary. If you got a 3-year-old child, how does that help the situation with your coverage, right? That means that there's going to be several years that the family's going to struggle because 1 or 2 years of your salary isn't going to last very long. So let's look at how the financial house and why life insurance is so important to supporting the your financial house. So you see protecting your income, right? What happens if I pass away too soon? I need to be able to replace my income. Having a budget, an emergency fund or will, paying off debt, planning for retirement, college savings, other goals and dreams, right? All those things aside from life insurance, you can build over time. But if something happens prematurely, right, then you're going to run the risk of all your financial house crumbling because there's no coverage in place. So we definitely want to look at that. And there's a cycle when it comes to not having life insurance. And I'm going to pull that up. I am having a little technical challenge, but if you can pull up the cycle of life insurance. All right. So when there's no life insurance, right, there's no money for your funeral. That's definitely problematic, right? If I don't have any money for a funeral, we talk about passing wealth and all of that. But if I don't have any money for a funeral, my family's going to struggle to even bury me, right? So hence the creation of GoFundMe, because now we got to find a way to professionally beg people to pay to get me buried. So you see GoFundMe on the rise and people contributing to it. But statistics also show that people don't even get 1/3 taking on a huge debt in the family, because realistically, you're going to your family asking them for money to help to get your loved one in the ground. So you can see poor planning. People are doing fish fries and all kinds of things to come up with this money. I'm sorry, y'all. I think I got it together. But you're seeing the people begging to get their loved ones in the ground, and it's just really hard to watch, right? When we're watching a family do a GoFundMe, when we're watching celebrities do a GoFundMe, right? We have seen celebrities. Most recent, I would say, PNB Rock. He ended up getting shot at the Waffle House, and there was no coverage in place, right? So that definitely created a problem for his family, because not only was there no coverage, but they couldn't even get Social Security because he didn't have any Social Security work credits. So okay, we can't get I'm sure they were able to maybe come up with money to get the funeral paid for, but he had a baby, right? So family members can't afford to travel to your funeral, right? Because it's untimely, or maybe they had to donate, right? So you see this whole cycle. Families forced to cremate your remains for financial reasons, no grief counseling. There's no time to grieve because your family members have to try to pick up the pieces, no money to cover the lost wages, right? I keep talking about income replacement to replace your paycheck, right? Because if you pass away and if you're a single parent, or even if you're married, half that income goes away. And if you're a single parent, all that coverage goes away that was taking care of your loved ones, right? So the family members have to go back to work before they're ready, right? That definitely creates a problem. They're not ready to go back to work because they're grieving, but they still got to make a way for the family to eat. So that's problematic. Family has to repay debts, right? Because they don't borrow money or whatever the case may be. Sometimes they're taking out loans and all kinds of things. So the no life insurance wheel is definitely problematic. And that is how poverty continues to be passed. So if we go to the next slide, I want to talk about the two different kinds of life insurance. My lighting, I think, is what is a big challenge at this point, but we're going to keep it moving, right? So there are two different types of life insurance, right? You might see it on TV. They'll market it. It builds cash that you can borrow against, right? How that whole breakdown works is, if you had $169 that you were gonna pay with a whole life policy, we have the face amount, which is the actual coverage amount, and then we have the cash value amount. So part of the money is going towards the actual coverage, and then the other portion is going towards a cash value savings, right? That they say that you can borrow against. So the insurance itself, to get 50,000, it costs $69, but they take 100 of it and they're putting it towards this cash value, right? So that if you need it, you have access to it. You got an emergency, you have access to it, right? So with the 10,000, right, there is some stipulations, and you can certainly take a look at your own policy to see if this sounds about right. Some people actually know this whole thing to be true, but and some people are even okay with it, where for the first 0 to 3 years you're paying money into an account and there's no balance. They say that it goes toward administrative fees or something along those lines. So I gotta ask, how would you feel if you were putting money into an account where nothing was accruing? Right? 0 to 3 years, administrative fees, that's $100 times 36 months, right? Of you paying into this and not having any money to show for it. 2 to 4% rate of return. So this money is growing. However, it's growing very, very slow. So we don't have a lot of cash value when it comes to our money, right? So we'll see what interest does in a minute when it comes to the growth of money. If you ever need to borrow it, right? And I say borrow because I need you to focus on that word. When is the last time that you went into your bank and borrowed your own money? When have you ever done that? Have you gone in and said, I want to take out $500, and they tell you to fill out a loan application? When has that happened? Right? That's not something that has happened to me when I've gone into the bank, but somehow or another they convince us that it is okay to borrow against our own money, right? So if you got to borrow it to get it, right, did you know that if you never used it, say you never borrow from it, they're going to keep the savings. So if they're going to keep the savings, you got to borrow it to get it. And one other thing, if you don't pay that money back, they never sweat you for it. They're going to take it from that face amount plus the interest. So if they're going to take it from the face amount with the loan, you had to borrow it to get it. If you die and you never use it and they keep it, who are you saving this money for? And I think that there's a lot of things going on on social media and things like that, where they're really trying to jazz it up to get you to be okay with borrowing your own money, the whole be your own bank thing, or, overfunding your life insurance so that you can have more money in the cash value to borrow against, right? So I don't know if that's a plan that you want, but if life events are happening forcing you to have to borrow the money, then it might be harder to pay it back. And then if you're using it to build, there people will say that they're going to go ahead and use it and they're going to start a business. You can put your money in other vehicles to grow it faster and still start a business, and you don't have to borrow anything, right? If our key is to not have a bunch of debt, we certainly don't want to do it with the life insurance policy. And people are like, oh, your bank will have stipulations this way, you could borrow from yourself and you don't have to have the stipulations and all of that. It's still having to borrow from yourself and it not functioning as a life insurance need, right? You're more borrowing from the cash value than you are actually using this for what it's for, which is to protect your paycheck. So when it comes to the other side, term life insurance, and you can tell me which side makes more sense to you, right? Term life insurance, we take that same $69 and we can get you 250,000 with that, right? Versus on the other side, we could only get you 50,000 for $69. So it's already overpriced on the other side. But we said, okay, we're going to give you 250,000 for your coverage amount. And then we're going to take the other 100 and we're going to go invest it, right? We're going to ask you to act like you didn't save any money, right? Take that $100 that we saved you and go put it into an investment and grow it at 8%. It's a separate investment, and it grows alongside of the life insurance while you have it. So you're renting an estate until you can grow one. Does that make sense? Where you have this money in case I pass away, my family gets this. But if I pass away while I'm growing my money, my family will get this as well, versus one or the other. The company keeping your savings versus your family getting whatever you had in your policy plus the money that you were able to save. If you keep things separate, you can certainly start a business with this money. You don't have to borrow it from yourself, right? You have an instant balance. So whatever you have in there is yours to touch. You don't have to wait any time. You don't have to borrow from yourself. You don't have to do any of that stuff. So you have higher rates of return because your money is actually being invested in the global economy, right? So you have a higher rate of return. So that's how the money grows so much faster. It's yours to withdraw. I don't need to fill out any kind of application saying I got to pay this money back. And then if I pass away, like I said, my family is going to get both. But if I live a really long time, I definitely need this money for spending. So if I look on the left, my money didn't really grow very fast. But on the right, I got over 320,000 and I got more coverage. So my financial health is going to be much stronger this way because I have money if I pass away too soon, but I've also grown money in case I live a really long time. Can we go to the next slide so that you can see a little bit more of what I'm talking about? This is called the theory of decreasing responsibility, how life works, right? In the early years, when I have young children, high debt, a house or mortgage, a loss of income would be devastating. The family now has to plug the hole of my income. So I need to have money on hand if, God forbid, something happens, right? In the later years, I may not need a lot of coverage. Why? Because my children are grown, right? Hopefully not sleeping on my couch. My debt is lower. My mortgage is paid off. I need spending money, right? So in the early years, I don't have that kind of money laying around. But in the later years, I better have some daggone money laying around, right? So life insurance wasn't meant to ever be forever that you needed it. It was supposed to help to go with you through the cycles of life. What happens if I pass away too soon? What happens if I live a really long time? So, yes, the idea is not to have to need life insurance forever, renting an estate so you can grow one. So that's the theory of decreasing responsibility. And I think that this is a lot of the times why we pass poverty, because we're not necessarily growing our money in the right places. We have it in these policies that aren't growing very fast. And so we don't save money and we have a small policy. So move to the next slide for me. This talks about the rule of 72. This is what you can do with your inheritance, right? If someone were to leave you money or you were to leave money to your kids, this is what I teach my children, right? Where I tell them, I may not have come from a rich family, but a rich family is going to come from me, right? Where I can go ahead and show them, this is what I want you to do with the money if I am no longer here, right? Rule of 72 says it's the banker's rule. So on that other page where it talked about whole life and the cash value growing at 2 to 4%, that interest rate, if you divide that into 72, it tells you how many years it takes your money to double. So if you got $100 growing in a whole life policy, if you divide 2 into 72, that $100 is going to become $200 in 36 years. Right? This is an Albert Einstein concept, but it talks about interest, how and maybe you have credit card interest, but it all works the same. But if we're making our interest work for us, we need to know what it looks like, how this money is going to grow. So for a life insurance policy, if I left my children 320,000 and I have them invest some of that money is going to grow at a much faster rate than if I stuck it in a 3% account or even in a bank account, right? I think sometimes people take inheritances and they go stick it in the bank. Banks are giving us 1 to 2% on our money. So there's no way for the money to really double fast enough to create an estate that you can continue for your children's children's children, right? We are talking about creating generational wealth. So we need to show what this looks like when we actually invest in inheritance, a $250,000 inheritance at a 12%. You can see that that money is growing every 6 years. So this is how we pass wealth, right? Because we can make sure that our children do the same exact thing. So we see 6% it grows a little bit better, right? Where it's growing every 12 years. But that 2 to 4% that we saw on that other page, we could see that our money is not going to grow very fast if we're putting it in a cash value policy. So when it comes to doubling money or it comes to leaving inheritance, what if you could stipulate this, that your children do the same thing for their children, take some of the money and invest it, right? So that the money continues to grow and we continue to pass it from generation to generation, right? I think that a lot of the times people don't think that they can do these things. They don't think that life insurance is affordable, but we just showed you on the other page where life insurance is actually very, very affordable. You can get a great coverage amount, but we got to get in the habit of not just having a policy, but saving and growing money alongside of it so that we can Really, I think that if we had at least a $250,000 life insurance policy, we would stop passing poverty. We would stop sending our children to go live with a loved one and weaken the structure of their financial house, right? Um, but we could have our houses paid off versus people having to sell their home, right? So we can't win the money game if we don't know the rules, right? So we have to not just teach the life insurance policy, but how we can make the money work for us, even though you lost a breadwinner or, someone that you were close to. Banks or insurance companies don't really have an incentive to teach us this rule, right? Because they're the ones that get to take advantage of giving you a low interest rate, or the insurance company is banking on the fact that they hope you don't know how your policy works, so that you don't see all of this fine print and you don't have to get upset and you just go along with thinking that you need to pay on something for your whole life. The wealthy structure things a little bit differently so that the money continues to work for them. Honestly, I think too, if we all had policies, what would the killing of unarmed Black people be like if insurance companies got to pay out this kind of money? Record executives count on the fact that their recording artists don't have any kind of coverage. Nobody's really necessarily worried about the people who don't have any money. They don't have any buying power with their voice. So I guarantee you, if insurance companies had to keep paying for these unarmed killings of unarmed Black men or Black women, I think things would be a lot different, right? But we never know, because they're always banking on the fact that we don't have the information and that we're living in a poverty space all the time where we're not thinking this far ahead. But if somebody would have caught me when I was younger and even showed me this rule of 72 when it comes to growing and saving money, I had a small inheritance when I lost my dad. Maybe I would have done something different with it, right? Everybody would benefit from learning this rule, but yet they're not teaching it to us in school. We need to know what to do with the inheritance. Next slide for me. This illustrates it a little bit more, right? The family tree. Grandpa leaves 250,000, grandma leaves 250,000, right? In Proverbs 13:22, which is what we've been talking about this whole time, a good man leaves an inheritance to his children's children, right? So child one gets 250,000, child two gets 250,000, right? They leave it in the will to invest 100,000, and then it turns into 500,000 over time, right? So then they have their grandchildren, they leave them 500,000, right? You see that the money that they leave keeps going up. The grandchild one and grandchild two get 500,000, have them invest 200,000. The next thing that they're leaving to their children, they're leaving $1 million. Right? So then grandchild two turns around and does the same exact thing. We have to be willing to learn how to teach these wealth building strategies and principles. And some people, I try to have a lot of slides because I want people to see it, right? I don't want to just talk it. I actually want people to see how this works so that we know that it is in fact possible, right? The money in a life insurance claim is tax-free money, right? So you know what I mean, there's a way to leave money tax-free to your children and teach them what to do with the money while you are here. Show them what it is that if you have a large life insurance policy, what does it look like for them so that they understand how to hold on to something, and then they can invest in real estate, they can invest in different things, but we have to know what to do with the money, right? So people they have reasons as to why they just haven't done this. For one, we were not even allowed to pass wealth unless you were light-skinned enough prior to 1981. Right? If you weren't light enough, you had to just get a whole life policy. People are super familiar with whole life because that's what they have been circulating in our communities for decades. And that's how we're passing poverty. I'm sure if my parents knew, I lost my dad, but if my parents knew that they could get so much more coverage and pay less money, I'm more than sure that they would have done better. But realistically, they just weren't being taught the information. So we want to stop the generational ignorance, right? We want to stop the generational curses, and we want to start passing wealth. We want to end the cycle of passing poverty. I think that was my last slide. I think that was the last one. But I was wanting to really break this down some so that we can start to move in a different direction when it comes to this, right? Because ultimately, people have reasons. People thought it was unaffordable. People just didn't get around to it. People didn't see the importance of it. I hope after today you can see why this was so important, because we can, for under $100, we could secure our family's financial future, right? We can leave a love letter that says, I loved you enough that I wanted to make sure that your life was either better or the same, right? We definitely don't want to keep passing the cycle where people's lives are worse, right? Worse than when the breadwinner was living, because half the paycheck or even the whole paycheck left when that income earner passed away. So death and life insurance and estate planning and all of that isn't necessarily the sexiest thing to talk about, but it is such a necessary topic when it comes to breaking these cycles. We're in an era where we hear people say all the time, generational wealth, I want to leave a legacy, I want to do this, I want to do that. But a lot of the times we are not being taught the right information. If we find the information, it's not in terms that we can understand. I'm more than sure that a lot of people don't necessarily read the fine print on these policies that are putting it in writing, telling you that they're going to keep your money. If you need to get your money, you have to borrow it from yourself. And they've made it sound very, very attractive. And I'm just on a mission and a crusade to teach people a different way, right? We got to start saving money and planning ahead. That financial house that I showed you, the life insurance is the foundation. But when we want to stop working, we need to be growing some money alongside of it so that we don't outlive our money. So we will definitely be diving next week into more of the financial house and what the investments look like. Maybe even talk about emergency accounts, college for children, so that we don't have to send our children to school with a bunch of financial loans and debt and things like that, which is really modern day slavery, because if you don't pay your student loans, you can't do anything. Just making sure that we're out of debt, and as we continue on a journey, right, everybody's at a different space and place, but we want to start with the foundation, which really is the life insurance, right? Making sure that we have enough, making sure that we have coverage outside the job, making sure that we are maximizing our savings and interest by putting our money in an account that will grow faster, that doesn't depend on whether or not we borrowed from it or whatever the case may be. So, I'm just on a tear, right? I have committed myself to helping 30 families this month to really take a better look at either getting a second opinion. Maybe you do have coverage, and kudos to you, because it's better to have some than none, right? And then there's some people that may not qualify for every type of life insurance, but don't you want to know, right? You want to know what you qualify for. You want to know how to get the best rates. I'll be honest, the younger and healthier that you are, the better your rates are going to be. The older and less healthy that you are, it's going to be a challenge. So when people think it's too expensive, it usually has something to do with age, right? The older you are, the higher the life insurance costs. If I could catch a whole bunch of 25-year-olds, 20-year-olds, the coverage is dirt cheap, right? For hundreds of thousands of dollars. So when you do start a family, your family has you're leaving some kind of legacy to them. So I'm trying to catch people as young as 20. I put a policy on a 22-year-old. I got him $276,000. And if I'm not mistaken, he was paying like 30, 40 bucks, right? It is very, very doable. And it at least gets that first layer taken care of. So now I can focus on getting out of debt, on planning for retirement, making sure I have 3 to 6 months of my salary saved in an emergency account, right? All the things that we've been talking about over time. So we'll continue to have these conversations. I'll continue to repeat it because I think that at some point we're catching on and we're making some better choices. We just have to be exposed to the information. So repetition being the mother of all learning, I'm going to continue to drive this home. We're going to have another show about this financial house because it's just that daggone important, because you need to know how to build it, right? So that concludes this episode of Your Money Matters Financial Empowerment Show. I hope that tonight what we shared gave you a different perspective, right? Making sure that you have some kind of coverage lined up outside of work, right? They don't give you enough time. If you lose that job, you don't have a lot of time to get coverage. If you don't have any coverage, feel free to reach out to me. My Facebook name is Letha Thornton. You can certainly look me up and or even comment on this thread where if you have no insurance, we need to talk. If you got job insurance, we need to talk, right? Because we want to get something portable that goes with you no matter where you work, right? If you have the kind that grows cash value, we need to take a look, because 9 times out of 10, you're underinsured if you have small children. If you do not qualify for another type of insurance, then something is better than nothing. But if you are a young person with young children, you probably qualify to have more insurance coverage than you have currently. And I sit with families and I calculate with them how much they actually need. Right? How much do you need to properly replace 5 to 10 times your income so that your family doesn't go into a financial hardship? Widows losing their homes, things like that. So we're definitely going to continue to dive into these worthwhile topics. And if you have any questions, you can certainly reach out to me on social media, shoot me a DM. You can comment on my own Facebook page or even on this page. Tomorrow, I will be doing another workshop. If you're interested, you can certainly let me know. I'm doing that with a Delaware group. So, but it is open to all. You can come and learn some of these things. Again, maybe you need a recap. Maybe tonight it was a lot for you to understand, a lot of information, a lot of processing, but you can definitely attend that tomorrow. Feel free if you want to do that. And lastly, before I let everyone go, I am always looking for people to get licensed to do this as well, to teach people the financial principles. So my company definitely will help you pay for your licenses and help you to have coaching and mentoring to understand how to help families to get this done. So I bid you all a great night, and join us next week when we will talk a little bit more about building the strong financial house and how investing in the right vehicles can help us to maximize our savings and interest for retirement and other goals and dreams. So I wish you all a good night. Thank you for bearing with me with my technical difficulties, and I will see you next week.
CMPRadio.net, it's the station. Listen, man, let's cultivate together. Bring us all your show ideas. Content creators, we're looking for that. Videographers, we're looking for that. You can be a part of the next great big thing that takes place right here in Chesterfield.